Hi, my name is Gigi Ricarse, and in this video, I will be sharing with you the 4 ways Canadians can minimize their taxes. The first way is through a government program called the Registered Retirement Savings Plan, or RRSP. An RRSP is the most effective retirement savings and investing tool available to most Canadians. It lets the money you invest grow unaffected by taxes until it is withdrawn. That means your money has the potential to grow faster and accumulate more returns. What's more, you'll get a tax deduction for every dollar you put into an RRSP, reducing your annual tax bill. Here's how it works. The fact that your plan is registered with the Canada Revenue Agency allows you to benefit from this tax-deferred growth. Outside an RRSP, most investments are taxed. Interest earned is fully taxable, half of capital gains are taxable, and dividends are taxable but eligible for the dividend tax credit. Inside an RSP, none of these taxes apply. Because you pay no tax on investment growth while your money remains inside an RSP, your investment compounds far more quickly. At the end of the road, that makes a huge difference. Even though you'll be taxed on amounts you withdraw from RSP savings during retirement, your tax rate will likely be lower than during your working years. The second way to minimize your tax is through another government program called the Registered Education Savings Plan, or RESP. RESPs permit savings to grow tax-free until the beneficiary is ready to go to college, university, or any other eligible post-secondary educational institution. Under the Family RESP plan, if your child decides not to attend higher education, the RESP can be transferred to another beneficiary such as a sibling. RESP assets can also be transferred into parental RRSPs, provided the parent has enough contribution left. Plan continues to grow sheltered from tax. Each child beneficiary can collect up to $500 from the Canada Education Savings Grant per year, to a maximum of $7,200 over the life of the RESP. There's an automatic 20% return on your investment. The simplest way to achieve this is to set up a convenient pre-authorized contribution of about $208 per month. And the earlier you start, the more you take advantage of accumulated growth. The third way to minimize your tax is through this government program called the Tax-Free Savings Account, or TFSA. The TFSA was introduced by the federal government to help Canadians save and invest for their future. Canadians who are 18 years of age or older may contribute up to $6,000 per year to a TFSA. TFSAs are great because the earnings are tax-free. Your TFSA contribution can go to a wide array of savings and investments. Withdrawals are tax-free as well as the earnings. Unlike RRSPs, if you make a withdrawal from your TFSA in a year, it creates new room. You can therefore put the amount withdrawn back into the plan in a subsequent year. The fourth and last way to minimize your tax is through the cash value of your permanent life insurance policy. Permanent life insurance not only covers risk, but also acts as an important vehicle to maximize estate and retirement planning, as well as business succession planning. This additional money is invested and grows tax-sheltered, similar to an RRSP. It is one of the few outright tax-free intergenerational transfers allowed by the CRA. In addition to the tax-free death benefit, the policy owner can access the funds for other purposes prior to death, for example, to pay off a mortgage or supplement retirement income. These tax-efficient strategies are available for every individual's needs. Take the first step today to better achieve your financial goals. Brought to you by Prosecure Financial, proactive solutions to build and secure your wealth.